Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone, welcome back to another weekly Roundup edition of On the Margin. Today, I'm joined, as always, by my boisterous co-host, Mr. Mark Yusko.
Boisterous. I thought you were going to go with boyish because I'm wearing the hoodie today.
Hey, looking good.
And actually, I am feeling rather boyish. I'm over my cold that I got last week in Vegas, and I just flew in this morning from Austin, and I don't have to climb up on the chair today to do the sock reveal because I was out putting up Halloween decorations for my wife, and the sprinklers turned on, so I got all wet. So I have the sock. So the funny story is, I'm in Austin, Texas. I pull on my Bitcoin pants to get on the plane this morning for Bitcoin Friday. I pull out a pair of socks, and it turns out my socks are mismatched because my son, my 12-year-old, was multitasking while he was matching socks, and so I got the history of Bitcoin and cold storage. So you get a double sock reveal today, courtesy of my multitasking son.
I thought you were going to say, because my mind is just like Einstein and I can't be bothered with the mundane tasks of matching my socks.
Well, and to
mental effort.
Oh my God. Okay. Now that's what he's going to go with. Okay. So now I got to tell my son that he's Einstein. Great. Yeah. And, but the funny thing is, boys will be boys. He's literally in the morning, okay, eating a cereal. He's got a video of one thing. He's playing his game with the other, and he's doing the socks. So total multitasking. And anyway, but my wife said, "Hey, just own it." And I'm like, you know what? I'm gonna own it. I might start a trend. Well, I know other people already do this, but maybe I'll just start wearing mismatched socks.
My socks are probably mismatched about 20% of the time. I know. I know you were down in Austin for a conference. What were the vibes down in?
So,
good?
That's 2 in 2 weeks where the number of people was down. Now, this was a venture capital annual meeting as opposed to the Filecoin meeting, which I was at in Vegas last week. So the number of people was down, but the people there, oh my God, I had some of the most epic conversation. I had a life-changing conversation with Caitlin Long yesterday for almost 2 hours. And she's going to change the world. But I mean, it was awesome. And I met this young guy from Russia who is building a middleware layer. Blown away. I'll show you a picture. It'd be people. I'm at the risk of like alienating half the people listening to this show. So there is the orb. And there is my proof of humanity. I have been scanned. I have a digital ID. I listened to Alex Bania. Wow. I mean, just wow. I've never met Sam. I mean, no, I've heard of him. I've seen him talk, but I got to spend some time with Alex. I mean, that guy's brain is on another level, right? I mean, he was doing AI research at Caltech. Sam found him, said, "Hey, come help me do this." And I'm not saying that it's the key to global tranquility, but I was blown away. And then there were a couple other guys that I met, again, young guys. And when I say guys, I mean guys and gals, but just unbelievable. And some amazing stats on, and you'll love this, right? Permissionless, and you're an ETH head. The numbers on ETH.
You know what's funny is I get accused by every ecosystem that I follow and love and support of being a supporter of another ecosystem. People Bitcoin tell me, "Oh, you're an ETH head." The ETH people are like, "Oh, I know you love Solana and Cosmos." It's like, yeah, I like all of them. I'm a supporter of all.
I am a technology. We are technology maximalists.
Agreed.
Plain and simple. We are technology maximalists. And this, I got another one this morning. "Oh, you're shitcoining again." I'm like, please stop.
These people.
I mean, again, and then again, I don't mean this in a braggadocious way, but I own more Bitcoin than that person who's trolling me. And I also own a lot of Solana, not as much as I used to. And I have a bunch of ETH. But I will say, as much as I was starting to come up the Solana curve, and the guy in the Netherlands had done a really great job, kind of helped me up that curve. Some of the data that the guys at Blockchain Capital shared yesterday were wow. I mean, ETH dominance is amazing. Developer dominance, project dominance, market share of NFTs, of everything. I mean, it was, well, actually, I think
the only thing that I would say to that, though, and I agree with you, ETH is extremely dominant, is it's also wildly consensus. Actually, the entire time that I've been in crypto, I've only ever seen so much consensus in one other period of time around one other asset, which was Bitcoin in 2019. And that's what ETH reminds me of today. And not to say, by the way, not to say that Bitcoin didn't do well 2019 through 2022, but it underperformed most of the rest of the market. So I would just say,
but listen to these stats, Mike. I mean, this is, I was actually a little shocked by this. I would not have thought these were this down. So in DeFi, Ethereum plus the roll-up, so it's Ethereum plus the L2s, 65%, Tron 17, like Tron 17, Solana 1, Avalanche 1, Bitcoin Smart Chain 6. Okay, for NFTs, ETH 75, nothing on Tron, Solana 9, Avalanche 1, and BSC 5. Stable coins, ETH 67, Tron 36.
Yeah, I was not going to, because most of Tether settles to Tron.
So. Okay. So that's really a zero. No, I'm just kidding. Just kidding. Solana 1, Avalanche 1, BSC 4, DEX volume, ETH 75, Tron 0, 3 for 3, 1, and then 14 for Binance Smart Chain. So, I mean, those are big numbers. And, look, there's just no way, in my mind, you can be competitive for the daily exchange of value at the level of ETH gas, right? I don't think you can do it. So you got to have other things up top of that. And that's why I think so like Solana seems so good for that. But anyway, what I came away from was incredible enthusiasm for the technology. I mean, this was a day of technology, all deep technology talks. And I went to the breakout because I wanted to get smarter, because I'm not a tech guy, on the networks and protocols. And they went into a discussion of ZK snarks, which I actually learned what SNARK stand for. Oh my God. They were speaking a foreign language. And when the guy said, well, like polynomials from algebra, I'm like, forgot that. Like 40 years ago.
I know.
The polynomials.
It's interesting that you're saying, because the data points, I would agree with you as well. And just to give you another data point, what I think this is a US thing. So for instance, we talked about this last week as well, but we're in the process of launching DAS London. We've done London in the past before, and it's always like, there's some good response. We usually get a little bit fewer people. I sent 20 emails out, just like, hey, wanted to get a sense if you were interested in speaking. I got 17 yeses already. People locked in, and these are
just don't let them bump me. Don't let them bump me.
Hey, I've been hounding you. I've been like, man, can I get my hard confirmed here? All right, cool. All right, good.
Confirmed.
All right, so Mark's gonna be there.
I'm confirmed.
We've got
jolly good. Brilliant. It's gonna be brilliant.
And let me give you a sense of the range of people. So we've got the head of global crypto trading at Goldman. We've got the head of crypto at Point72. We've got head of crypto at JP Morgan. So the big banks. But then we've also got the in the weeds.
They don't do crypto. They tell us all the time they don't do crypto.
I actually am curious. I don't, I would love to get a sense of the on the margin audience because I'm sure many people follow Jamie Dimon, what he says about crypto. They've had a 200-person team on this forever.
There are more ex JP Morgan people almost than any other ecosystem people. I mean,
yeah,
they've had a lot of people for a very long time, and he badmouths. But remember what he's doing, right? And this is what I had the long conversation with Caitlin about. He badmouths it, and he's got all these people working on it because they want to do the flip. They want everyone on evil coin, right? Which if you watch Mr. Robot, you know what I'm talking about, but it's JP Morgan coin. And that's what he's doing. And there's some interesting things going on with the Fed and the regulators to try to force all of what we believe in with life, liberty, prosperity into this permissioned. I mean, look, I came away from your event in Austin, back in Austin, so psyched. I mean, I was like, be permissionless on my chest, hashtag. I mean, I was like beating my chest about living my life permissionless. And that's my goal for the next, however many long years I get to live. That is it. But these guys don't want that. They want a permissioned world where they are in charge, and we need to fight back, which we are. But anyway, sorry, I interrupted.
Yeah. No. That's okay. I think there will be. I think at the layer of where JP Morgan and these banks want to play, there will be compromises. Like for instance, most of the on-ramps today, the Coinbases and the Krakens of the world, they're centralized. And I think there will be a market for centralized players that want to hold, our grandparents' coins eventually.
Yeah.
That doesn't actually make sense and I do push back. Sometimes I see people share, we should be pushing people towards self-custody. And it's like, in theory, I like the idea of that, but the reality is you're going to have a lot of people that end up losing their funds.
How many people keep all their money in their house?
No one.
Not very many.
Actually, my grandma.
Some, right?
My grandma.
No, but there are some. I mean, there really are some. In Greece, it's actually a really high number, right? There were lots of people that took it all out of the banks and put it under the mattress. But that is rife with peril. And, so is everyone having self-custody in its current form. In a future form of self-custody, where all of the hard stuff is invisible and there's a better system of digital identity and custody. Yeah. Then when it's invisible, like when you first, most people won't remember this. Like when you had to take your computer apart to upgrade one of the chips or the RAM so it would actually run the new software upgrade. There weren't a lot of people that had computers. It sucked because if you put the screws in wrong, it didn't work. And if you put the chip in back, I mean, it was hard. And now you open your computer and it works great. And if it doesn't, you close it and you go get a new one. I mean, so anyway,
it's a tough, and I think so I think there will be a sort of few, but regardless, I always think it's interesting to hear what big institutions are thinking about and talking about, because my framework has always been some of them will not adapt, some of them will. And probably it's a pretty good bet that the Goldmans of the world and the JP Morgans are going to find a way to be relevant in crypto.
Let's think about this for a second. How many ex-Goldman Sachs people are heads of central banks, heads of state? Okay. Like they run countries. So, I mean, other than the WEF new global leaders or whatever they're called, young global leaders, I mean, which is an increasing number who are in charge, it's Goldman Sachs. Full stop. So the idea that Goldman isn't going to be not only just relevant, but large and in charge, and BlackRock falls into this, and there's some really funky stuff going on there. And further to my point that they will be the ETF that is approved, and probably I'm going to stick with it, the only ETF that gets approved.
That's what makes this timing. So this is happening in March, and this is around the time that the
Oh
ETF
man, we're gonna have so much fun.
This is going to be a blast. And you know what? I just as a nerd for getting unique groups of people in the room. So in addition to the institutional crowd, we've got the Evgenis, the Stanis, so the sort of winter mutes and the Aves speaking as well. Just a really great group of people. So if the institutional part of crypto is your scene, this is the and by the way, margin 20, because Mark and I, we just can't stop giving back to you, the audience. So margin 20, it's going to get you a discount for the conference. You're going to meet us in person. We're doing a little bit of fun live podcasting.
So many selfies.
Mark, we got to
so
talk
we're
about
gonna do so many selfies, so many hashtag tags. I mean, it's going to
be a blast. It's going to be a blast.
I can't. I mean, it's just going to be amazing.
Yeah, fish and chips, baby, fish and chips. All right, let's because we got to give the folks some of the macro analysis that they come here for. Want to talk to you, Mark?
There's been nothing going on in macro this week. I don't know what we're going to talk about.
What's been happening? Yeah, what's been happening? What I want to talk to you about is this. It's the story that we've been talking about for the last couple of weeks, but it just keeps getting more and more pronounced. Is the long end of the curve and the sell-off in bonds. So we had Andy and Nick Jovanovich on the show this week, the two gray beards, and they were discussing. I think the big story when it comes to bonds right now is the issuance story. So they were both very good and sharp at pointing out that we haven't had a big Treasury auction since it was like Q1 of 2022. And what that meant was that you had a bunch of borrowers that did not need to come to the market. Now that you have the government essentially that's coming to the market. And by the way, for the first couple months of or for the first part of 2023, you had Janet Yellen spending down the TGA. So at the same time, you had a little bit of sort of anemic QT. You also had a drawdown in the TGA that neutralized it. But now the rubber's meeting the road because that's done. And now we're starting to see some pretty big bond auctions or treasuries auctions rather.
Yep.
So I feel like that's the story for what's going on. And you can see the movement in the 30-year, the 20-year, and the 10-year.
Look, it's a monster story. But before we start the story, one thing, next time you see Andy, you got to ask him what level Pokemon Go trainer he is. And
somehow I missed that.
And how many accounts he plays. Andy and I, not only do we share a great interest in macro, and we talk all the time, we also collaborate in Pokemon Go on a pretty frequent occasion, as do I. I mean, there's a number of people, but we have fun.
That's where the real alpha gets shared, on the Pokemon Go back channels.
You would be amazed in that, Colleen and I also share, she's another venture capitalist. And she is Bitcoin 21 million and I'm got Bitcoin. Those are our, call signs, shall we say, or trainer names. Anyway, so here's the interesting thing. Since we recorded the last show, how much are long bonds down? No, without looking. Don't look.
I mean, are we talking about the 10-year or the 30-year?
30-year.
So I know post the geopolitical tension, they caught a little bit of a bid. I would guess, I don't know, yields are probably at 20 basis points, something like that.
No, we're up 3.5%. Yields are down. There's been a so despite everything you said, which is true, and that long-term is going to be the issue, that there's not enough buyers. And there's this really interesting problem. So we've alienated our formerly largest buyers of treasuries, the Russians, the Chinese, Japanese, even the Germans and the French, and pretty much pissed off everybody, Saudis. And so who's going to replace that? Here's a crazy thing. If it weren't for Tether and Circle that own $90 billion of treasuries, rates would be in really significant pain right now. And so, and I think the point you said that Andy and the guys were making was that the mix of short duration to long duration is really important, right? Because if you have too much short duration, you're forced to refinance more often, obviously. And if you have to refinance into rising rates, that causes a death spiral. And, what's really odd is we had 0 interest rates on the short end and kind of 2-3% on the long end for a decade almost.
Mm.
Wouldn't you, if you were really prudent, have hit that bid and pushed them all to the long end? Like issued all 30, 40, 50, 100-year bonds? Why weren't we issuing 100-year bonds? But no, we kept issuing T-bills. And I think we're at the highest level, is that right? The highest level of T-bills to T-bonds in history. So
it's right up there. I think the level that Andy gave us was 20% is where it sort of tops out historically. That's just precedent. There's no rule that says they can't have a higher ratio of bills being very short term to bonds being longer term. And the key idea is that that's a signal of stress if that ratio moves too out of whack. What it says is the dynamic and the idea being, I'm showing, by the way, for those of you who are following along via video, the 10-year, 20-year, and the 30-year, and you can just see this extreme move in rates over the course of the last 3 months or so, which to Mark's point did revert a little bit within the last week. But the idea being the problem that the Treasury and the Fed are now facing is, we are still spending like a drunken sailor, right? The way we, because we keep spending.
I think there's a perfectly sober sailor, because a drunken sailor could not get to his wallet this fast.
We are actually a calculating sailor.
We are spending like a sailor on Red Bull.
Yeah, we're spending like a sailor who's got like 3, side mistresses, and he's scheming all of them for money. And he's borrowing their money too.
Exactly.
That's as far as I want to take this analogy. But the point being, the problem now is that the bond market has sniffed out that there's a supply issue, and because we didn't take advantage of basically terming our debt out when there was a lot of demand. Now we're in this position where we've already issued a bunch of bills, and now Janet has this problem. I keep saying that because the Treasury is the issuer of the bonds and they run these auctions, they have the problem of, okay, so the market is worried, as you can see by the sell-off in longer dated bonds, about they're worried about the supply coming online, but I still need to issue this so I could switch to bills, but then that would signal that there was some stress or I was worried about the composition of our debt, and then that would actually cause yields to sell off a little bit more. So that's the sort of situation. What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. I do feel like this is what the Fed wanted to happen. So the question was, there were a lot of headlines around, is the Fed losing control of the long end of the curve? And I kind of think they probably wanted this to take place because the Fed, what I think they've been trying to get at is tightening of financial conditions and demand destruction, right? That's what they need in order to slay the inflation beast. And part of what's been stubbornly persistent about that is they keep yanking up the rates at the long end, and they're inverting the yield curve, which you and I have talked about ad nauseum this entire year. But those long end rates were just stubborn. And part of that now, with the benefit of hindsight, was because the Treasury was spending down the TGA and they didn't have to issue any more bonds. So we didn't need to find a clearing price for that debt.
Yeah.
But now companies are going to have to come back to the market. There needs to be a clearing price for term. And that's what's happening with term premium is compressing. So one chart that Bob Elliott, who's been on the show a couple times, showed this week that I thought was pretty good. One sec. Is, as it relates to recession, one of the things that we've been talking about that we're waiting for is this compression of term premium, which is a bit of a wonky concept, but it's basically it's the amount that investors need to get paid in order to take on more duration risk. So this is now that we have a compression in term premium, the yield curve is starting to flatten. What also folks have been saying is that, look, it's not from the time of the yield curve inversion, then there's some number of months until recession. It's the time that the yield curve uninverts, and then there's recession. And so, and that's when you start to see initial unemployment claims move in the right direction. So that's what we're looking at here. This is the evolution of initial unemployment claims after a yield curve inversion, and it's sort of showing that we are historically, within the range of 12 months to recession.
Yeah.
On one hand, this is compelling. On the other hand, this is basically what we've been being told for the last 12 months. There's been a recession around the corner for the last 12 to 18 months. So,
no question. Although the thing is good about this is it does put into perspective that it's always been true that it's not the day of the inversion or the reinversion or the de-inversion. There's a lag. And this is showing that. And while it's not the fastest to the exponential increase, it's also not the slowest. So it's kind of right there in the middle. And now if the next 6 months it stays flat, well, then this doesn't work. It's kind of like the stock to flow model. I hate to pick on Plan B because I like his work, but at some point, if the model predicts something and it doesn't happen, if it doesn't happen right away, it's okay. If it doesn't happen after 6 months, okay, it's less okay. If it doesn't happen after a year, to your point, there's something that needs to be changed in the model. And models can change. That's the other thing. Models can certainly change. This one's harder to change because this is really not a model. It's not a prediction model. This is just facts. Right? These are previous periods of time. And what we're saying is if history rhymes, which you look at the chart, it usually does. And economic cycles do rhyme. I think what's interesting about this one is everything else is following in suit except for the employment numbers, the jobs numbers.
Yeah.
Think about it. Everything else from, shipping to trucking. Trucking is just a disaster, to housing prices. We had the smallest number of homes trade hands in the last 100 years, like sub 1%. So lots of things are all saying, things are slowing. Again, it's not a calamity. It's more like an 01 kind of recession. But the employment picture, it's like such an anomaly. And anomalies demand further study, right? You got to pick them apart and say, well, what's going on? And I've talked ad nauseum about the birth-death ratio. I think the big part of the unemployment numbers is most of it's fiction, but that's just me. I think you have to talk about the people coming out of the workforce, which is just bogus, right? When you turn 65, you're not out of the workforce. When you quit working, you're out of the workforce. But so there are some things that have never happened before. We've never had this many people over 65. Well, not never. It's been 100 and some odd years since then. But as a percentage, we just haven't been, because the baby boom generation was the biggest generation until the echo boomers, which is bigger. So, but these are cycles. It's kind of like when you have a lot of 25-year-olds, with certainty in 20 years, you're going to have a lot of 45-year-olds, right? It's not like you might have a lot of 45-year-olds. You're going to have a lot of 45-year-olds. And it's like convergence trading in bonds. If you buy an on-the-run treasury, in 365 days, you will own an off-the-run treasury. It's not a question of maybe. That's just the way it works. And so if you do a convergence trade in 364 days, that will converge. The problem is inside the 364 days, crazy stuff can happen. And if you have too much leverage, you go out of business, but long-term capital. So I do think the macro situation, look, who was it? Oh, Jamie Dimon, my favorite guy. Jamie Dimon. Now, consider the source. Why would he say this? said yesterday, this is the most dangerous time in our nation's history in many decades. Okay. Got Bill Ackman suddenly back from wherever he's been for the last 6 months and back all over Twitter yammering about stuff. And it's interesting. Again, these guys all come out around similar times, but, and then Paul Tudor Jones was on TV and he's great. I love Paul. Plus, I wish I had Paul's accent. I mean, other than British accent, which is the best accent, the true Southern gentleman accent is so good. And Paul's so good. And he's like supermodel handsome. But other than that, and really smart and really wealthy and successful and all the good things. I'm like, leave some for the rest of us, Paul.
Yeah, come on.
But he basically said, look, things are really not looking very good right now. He said, we have a fiscal, did he say calamity? It's a fiscal disaster. It was some really extreme word, right? That we're in a fiscal place, which is what you started the show with. We just haven't been in. And no Treasury secretary has really had to deal with what's about to happen, which is this ridiculous explosion of spending, no end in sight, and no one to buy our bonds, except maybe Tether. And whichever one says is a fraud.
Or us.
Or individuals, right? They could pass a law. They literally could pass a law to force us to buy treasuries in our 401ks.
Yeah. I mean, they could do something like, forget, someone described, I'm not deep in the weeds of Basel and the banking regulations and all that stuff that happened post Great Financial Crisis. But I do remember someone saying, if you were designing a banking regime that encouraged banks to buy bonds, this is a lot of what that would look like. So
well, they did. No, Michael, that's why we have the problems we have, and that's why there's going to be a boatload of
regional banks. That's why they got to bail
them
out too. I'm sure that's why they got to bail them out, because if they basically strong arm them into buying the bonds and then collapse the price, I mean, that's hardly fair.
And again, if your goal is to buy them all because you're going to do a debt jubilee, right? If you buy them all, right? If you own all the bonds, so you got both sides of the trade, you literally can cancel the trade. Bank of Japan is inching ever close. I think they're at like 75-ish%. And that, I believe they're going to be first, and then we'll follow later. And then we just start over, and prices will be a lot worse, but we'll start over. And the thing about it is the world goes on, right? There was a debt jubilee in the 1840s in the UK, and the world went on, and they became a superpower. They literally became the superpower.
I think that's the thing, that because people make these proclamations and the implicit, you're left to say, oh my God, that's going to be horrible. But no. I've started to I consume, like, I host this content with you. I listen to a lot of it on my own private time just because I find it interesting, and I do think it tends to slant a little doomerish. But I think whenever you advocate for some huge change, right? If we're at an inflection point, I used to be captain of my debate team. There's something called the burden of proof. The burden of proof is on you to explain why now is different. Like, why are we breaking from the regime of the last 100 some odd years? So I think you should just, add an extra, but I think that's what we're saying, right? Like, I think we're going to be okay, but there will be changes. It's kind of like what we said last week. I would love a politician to just come out and say that. I would vote for that politician. If a politician came out and said, hard times ahead, but you're an American, goddammit, and buckle in, I'd be like, let's go.
Yeah, let's go. Go. Now, the hard part is, for the people at the bottom, it's not good. It's really not good. For the people at the top, they don't really care. They're good. The people in the upper half, they'll be fine. It is really hard for the people at the bottom. And look, we've all seen pictures of the Great Depression, the bread lines and the Dust Bowl. And for the people at the bottom, it's super hard. But And if you look at the pictures of London in the 1860s, right? The people at the bottom, the Tiny Tims and the Christmas Carol story and all that, it's hard. But the country moves forward and moves on. And here's the thing. And wait, we talked about this, right? The reason I'm so excited about what I call my chapter 3 is, now I'm a venture capitalist, right? And what is a venture capitalist? It's someone who invests in innovation, but more importantly, you invest in human ingenuity. And the last 48 hours in Austin, oh my gosh, the ingenuity of these people building the future of money, of credit, of everything, of payments, of all of finance, right? Which, the internet of blockchains. So we went from the internet to the internet of think connected devices to now the internet of blockchains. It's an extraordinary move forward in technology and the innovation that's going to come from that. And, it's funny. So the WorldCoin guys are up there and they're like, AGI is coming, right? They're big AI people, right? AGI is coming. Like, well, I'm going to take the under, but okay. You think it's right around the corner. And this is, AGI is artificial general intelligence, where the machines are smarter than humans. Again, I'm taking the under, but maybe someday, but they think it's right around the corner. And therefore, because of that, they are proponents of UBI, which I think is the dumbest idea in the history of the world. Because I think, and he actually said this. And so I agreed with everything this guy said, except one thing. He said, we need to have UBI be part of this so we can, create wealth. Giving people money does not create wealth. It never has. It never will. Not ever. Human ingenuity creates wealth. Building companies builds wealth. Reinvesting capital builds wealth. Lending your capital out and letting people use it builds wealth. And Caitlin and I had our great debate on rehypothecation. And I've changed my view thanks to talking with her. She's a 1-to-1, no leverage, and I'm a 10 to 11 to 1. And she convinced me that in a push button world, can't have 10 to 11 anymore. And I think I probably agree with that. Hey. But then she said, you probably don't need 10 to 11 anymore because we're not an agrarian society. We're not a mechanical society. We're now a knowledge society. So we don't need as much leverage. I'm like, I probably agree with that too. And but here's the thing. I've had people say on the internet, you and Caitlin, you don't agree. Like, right? Why is that wrong? And then what do? We have a dialogue and a debate and we learn from each other and we take stuff away. And we sat there for 2 hours and had this amazing conversation about so many things. And I came away saying, you know what? I'm changing my mind. I still believe that fractional reserve banking is not evil, that it is not the worst thing in the world. It doesn't need to be replaced. But I do agree. It probably needs to be a lower level of leverage. I still think 1-to-1 is too low, but we'll continue to debate that. But we're still friends and we still hug. And it's just the fact that you disagree with somebody, you should want to engage with them, not like run away and say they're stupid. That's just dumb.
I agree. I want to bring us back to bonds because I've got some questions around inflation for you. But what do you think, Mark? I mean, have we reached a peak in yields on the long run of the curve? Is there still more pain to go in the bond market? I will say one investment idea I've heard. I mean, you can now, maybe this was slightly before the bid that bonds caught this past week, but you get 2.5% real yield on a 30-year bond. Mm-hmm. As far as investments go, I mean, that's pretty good. I don't know what the level is to induce
that's pretty darn good.
Investors to step in.
And I think inflation has peaked. I think we're heading back down with one caveat. If this skirmish, and again, I don't mean to your point earlier, prayers and hope for all the people impacted by this. I can't imagine what's going on and having to move and flee from bombs. And I can't imagine. I've never experienced that. So I'm not trying to minimize, but right now it's a localized, well, it's fine. We'll call it a war. It's not a skirmish. It's a war. It's a full-fledged war, but it's in a small area But if it expands to the region, oil prices go up a lot, like a lot. And if that happens, inflation short term goes up and economic growth comes crashing down. And in that scenario, I think your point on Janet loses control and she gets stuck trying to thread that needle and people call bullshit. And we're at 6% on the long end in 5 heartbeats. So, there was a guy literally, I think right after we recorded the show said, I'm all in long bonds, 84.04 on the TLT. Damn, that's brave. And he's been right? It's up 3.5%. That was a good trade.
What does that do, Mark, to ask if the long bond continues to rise 6-7%? And keep in mind, by the way, folks, rate of change, right? The second derivative, Mark, that you and I were talking about before.
Yeah.
That's an important thing here too. These are big moves, not only
no.
Mike,
That's the nightmare scenario, right?
Right.
Most people believe, and I think that's why wars are started, that war is good for the economy, it's good for stocks, and it's good for GDP growth. Well, it definitely is good for defense companies. It's definitely good for auxiliary businesses that support the war effort. And historically, it has been good for GDP growth. And historically, it actually has been good for the stock market. I fear in this case, where an expanded Middle East conflict would have such a deleterious effect on oil in a time where oil's still really important and where, we don't have the strategic petroleum reserve and all kinds of other challenges. I just think it would catch people off sides. And I think we'd end up with the 2022 kind of redo. I could see a down 20% in equities easy. You'd lose at least that in your long bonds, maybe actually you'd probably lose more like 30%. It'd be ugly. And the other problem is liquidity dries up, right? Because you got this commitment, to shrink the balance sheet. Well, I think they'd have to throw that out the window. I do. Because at the end of the day, there are no buyers. So the buyer last resort has to be the central bank. And that, my friend, is just what Paul Tudor Jones said. That'd be good for gold and good for Bitcoin. And I love how I like Bitcoin.
The barbarous relics is what he calls them.
The barbarous relic. It's the new barbarous
relics. The barbarous
relic.
relics.
New barbarous relic.
Now, there's a great chart here. I've got some inflation. But this, I understand that this is a left side of the bell curve thing to show here. But we spent a lot of time the last year and a half talking about interest rates. Are we going to go to 5%, 4.5%, whatever percent? I feel like at this point, it doesn't really matter if it's 5 or 6% on the short end of the curve. I think if you look back in time, what we're showing here is the Federal Reserve's balance sheet. And there's this history going back all the way back to 2008. I've only got this going back to 2016, but you can see at various times, crisis, enormous expansion in balance sheet, supposed to be temporary, runoff. You can actually go back and look.
Never temporary.
They succeed in running the balance sheet off about 10%. Yeah. That's about where they get to before the market just pukes.
Yeah, there's another crisis. And Michael, again, you're dead right. The short end just doesn't matter. No one borrows at Fed funds. Like the average car loan, which is a crazy stat, it's like 17%. It's like, no, there's all these zero loans. I'm like, yeah, rich people get zero, but the average person is not getting zero rates. I mean, they're paying double. I heard car loans can go all the way up to 29%. Holy shit, that's like a credit card.
Oh, but Mark, didn't you hear the good news?
No.
Paul Krugman told us that if you exclude car loans and food and shelter and everything else from inflation, the war's won. At very little cost.
I've always wondered what it took to get a Nobel Prize. And what it takes is just being a complete dolt, right? I mean, that is one of the dumber statements out of he's clearly a smart person. He has to be a smart person.
He's a smart guy.
Yeah. he makes these statements like, the internet will never be important than the fax machine. Okay, that was just a ridiculous statement. And just proves they don't understand technology. You find a lot of people don't understand technology. Okay. And then he makes statements during the financial crisis that were just like, Paul, really? And now, if you exclude all the things that you buy, right, there's no inflation. So look, we've talked about this over and over and over. We have currency devaluation, right? That's what we have. We created way too much currency, and the Fed's trying to fix that. I actually give credit to Jerome Powell, who might be the only person who isn't in the bad actor group. Right?
I thought he deserves credit.
He literally is independent. I think he means well. I think he's not part of the BlackRock, Goldman, Treasury secretary, like billions cast. I think he and you saw it. He's trying to run off the balance sheet. He's trying to. He got M2 negative for the first time in 100 years because he realizes Kelton was wrong. Right? You cannot create unlimited money with no impact. That was never a good idea. That was Krugman-esque. That was not smart. And I applaud them. But it did create currency devaluation. And it meant the price of everything that people need, housing, shelter, food, transportation, went up a lot. Not because those things got better, because the money got worse. And to your point, what is the only response when things get really ugly? Print more money, right? That's the only way out. And I mean, and it's just the law of large numbers, right? We created $500 billion in national debt in the last, 3 months? $500 billion? I mean, and someone put up, it took, I don't know what it was, 100 years to get the first $500 billion, and then we did $500 billion in 3 months. I mean, the only thing that makes me feel good about that is the opportunity in data, where I think we talked about this last week, right? That from the beginning of time to 2003, 5 exabytes of data were created. Today, Friday the 13th, 2023, 330 terabytes of data will be created. So data growth is growing faster than national debt. So that's a good, opportunity for investment. But the debt problem, the fiscal problem, Paul Tudor Jones nailed it. And if you haven't watched a CNBC clip, you got to watch it. It's only like 3 minutes. It's not like a whole afternoon.
We can link it.
And his conclusion is very sound, as it always is, and very simple, right? You need to protect your wealth, which, wait a minute, somebody else said that recently. Larry Fink said, you might want to buy my ETF, my Bitcoin ETF when it comes out to protect yourself against devaluation of the currency. Larry Fink, who called it an index of money laundering 5 years ago.
Yeah. So it's I'll give you the last word here, Mark. I think where my head is at right now is, all right, what happens if long bonds end up moving up? There's a bunch of duration that comes onto the market. Can't be good for risk assets. You have seen, to be fair, as a staunch supporter of Bitcoin, you have seen Bitcoin sell off. Gold has responded in a more positive way. I think the question is, where do we go? Where do we go from here? Does the Fed get their demand destruction and it's a nice sort of soft landing recession-ish, or is there some sort of break and it's a much harder landing? But conversely, the Fed is going to have to come in and backstop the system, because we've been talking about limbo and I feel like the next 3 months is where we're going to get our answer in one way, shape, or form.
We're definitely going to get an answer, and it's. I'll use the boiling pot analogy. We've been mired for a couple of years in the simmer mode. We're funneling money to Ukraine, and there was some skirmish. And at first it was at almost a boil. But then it like really faded to total simmer. Like no one talked really about it. There were fewer flags in people's front yards, but there was money still every month getting sent and recycled into defense companies, and their stocks went up. And okay, oil prices were stable. Now the flame's up a little bit. I mean, people shooting rockets at each other and killing people is I mean, it's escalating. And said if it stays contained, I mean, this is not the first time Palestine and Israel have clashed, unfortunately. But if it spreads, and if other people, like I saw a headline yesterday that Hamas had bombed Syria or something. No, Israel had bombed Syria. I can't remember. It doesn't even matter. Thankfully, it didn't happen. It was just a bad headline. But if it starts to expand, demand destruction definitely happens. Forget the no landing. Forget the soft landing. That's a crash. Now, is it a Chuck Yeager crash where you can walk away and it's a good landing? And if you can fly the plane the next day, that's a great landing. I don't know. But I would follow Paul's advice here. I would get hunkered down. The nice thing is you can get paid 5.5% to hunker down. And in a shameless self-promotion, right? Because I'm an investor in Custodia. Custodia got approved for a money market, 5.5%. So people can invest in Custodia's money market for 5.5%. And it goes to Northern Trust, right? Very safe and secure. And there are plenty of other options, but that's a good one. And I'd stash some money there. I'd clearly buy more Bitcoin. I would clearly have a little gold tucked away. And short run, I like the guy's trade from last week to buy a little TLT, but you got to be nimble, because if the skirmish dies down and we go back to Janet trying to place too many bonds, I think there's a lot more pain in the long end, to your point. And look, you've been beating this drum all year, and you've been so right, and it's been great advice. And I don't think, like, there are two ways long rates can rise. One is good, one is bad. The good is when it's rising in anticipation of solid recovery and faster growth. We like that, actually. Mm-hmm. And that's what you described last week as the bull steepener.
Right.
We love that. The other is not good. When a central bank loses control, and you've seen this happen around the world many times, it just hasn't really happened in the US very often. When the central bank loses control of the long end, that can get ugly fast, because so many people depend on treasuries as their risk-free rate, as their base rate. And so, and here's the thing. There's actually a bill that wants to destroy one of the marginal buyers of treasuries. They want to outlaw stable coins in any permissionless blockchain. Well, so you're going to vaporize 90 billion in demand for treasuries? That doesn't seem like a smart idea. So if anyone's listening, from Congress, I would vote against that bill, because that will cause way more problems than you think you're solving.
Yeah, I tend to agree. Mark, best hour of my week, my friend.
Always.
Yeah.
Thanks.
All right. Take care.